There is a moment in most people's financial lives when debt feels like the enemy, and that feeling is not entirely wrong, because for most people, in most circumstances, debt is quietly working against them in ways they rarely stop to measure. The average household carries credit card balances, car loans, student debt, and a mortgage, all simultaneously. And the common thread running through all of it is that every single one of those debts is making someone else wealthier, while the borrower works harder to stay in place. And yet, if you look carefully at how genuinely wealthy people and large institutions interact with debt, you find something that feels almost contradictory at first glance. They borrow too, often aggressively, and in some cases, they borrow far more than the average person would ever feel comfortable with. The difference is not the amount. The difference is the direction the debt is pointed. To understand this properly, you have to start with a concept that most personal finance conversations skip entirely, which is the distinction between consumptive debt and productive debt. Consumptive debt is borrowed money used to purchase something that loses value, generates no income, and leaves the borrower with nothing but a payment schedule and a depreciating asset or a fading experience. A car loan is consumptive debt. A credit card balance carried month to month for groceries and dining is consumptive debt. A personal loan taken to fund a vacation is consumptive debt. In every one of these cases, the borrower is paying interest on something that either declines in value immediately or disappears entirely, and the only person building wealth in that transaction is the lender. Productive debt, by contrast, is borrowed money deployed into something that generates a return greater than the cost of borrowing itself. And this is the category that wealthy individuals, real estate investors, business owners, and large institutions have understood for a very long time. The mechanics of productive debt are not complicated once you see them clearly. Imagine borrowing money at a 6% annual interest rate and deploying that capital into an asset that returns 9 or 10% annually over time. The spread between what you pay to borrow and what the asset earns is pure arbitrage, and at scale, that arbitrage compounds into something significant. This is not a secret strategy invented by hedge funds or billionaires. It is the foundational logic behind nearly every real estate investment, business acquisition, and leveraged portfolio strategy that has ever generated serious long-term wealth. The wealthy are not avoiding debt. They are selecting debt with precision, choosing only the kind where the asset on the other side of the equation is doing the work of paying the debt back and generating surplus on top of it. Real estate is perhaps the clearest and most accessible illustration of this principle in practice. When an investor purchases a rental property using a mortgage, they are using the bank's money to control an asset far larger than they could purchase outright with cash alone, and the rent collected from tenants covers the mortgage payment, the property taxes, the maintenance, and ideally leaves a margin of positive cash flow on top of all of that. Meanwhile, the property itself may be appreciating in value over time, and the investor is building equity with every payment made, almost none of which came from their own pocket after the initial down payment. The debt in this scenario is not a liability in the traditional sense. It is the mechanism that made the entire investment possible, and without it, the investor would need to save the full purchase price before ever owning a single income-producing asset. This is why serious real estate investors do not pay cash for properties when leverage is available at reasonable rates. The cash is more valuable deployed into another deal. Business ownership follows an identical logic at a different scale. When a business owner borrows to purchase equipment, expand capacity, hire additional staff, or acquire a competitor, the expectation embedded in that decision is that the revenue generated by the expansion will exceed the cost of the capital used to fund it. The debt is not consumption, it is investment in the productive capacity of the business itself, and the business generates the income required to service it while simultaneously growing in value. This is how small businesses scale, how mid-size companies expand into new markets, and how large corporations use bond issuance to fund growth without diluting shareholder equity. The mechanism is identical across all of those scales, and the underlying logic is the same one that has driven capital formation for centuries. What separates this behavior from the debt patterns of the average household is not sophistication or access. It is the question being asked before the money is borrowed. The average borrower asks, "Can I afford the monthly payment?" That question, while practical, is also dangerously incomplete because a payment can be affordable in the short term while simultaneously destroying wealth over the long term. A wealthy investor asks a different question entirely. What does this capital produce, and does that production exceed the cost of borrowing it? That single shift in framing changes every financial decision that follows because it forces a return on debt calculation before any commitment is made, and it filters out almost all consumptive borrowing automatically. There is also a psychological dimension to this that deserves serious attention, because the way people think about debt is shaped heavily by the environment they grew up in and the financial behaviors modeled around them. In households where money was always tight, debt is experienced as danger, as a signal of failure, as something to be eliminated as quickly as possible. And that emotional association, while understandable, can actually become an obstacle to wealth building when applied too broadly. The person who refuses to take on any debt, ever, under any circumstance, is also refusing the mechanism that has historically allowed ordinary people to acquire income-producing assets far sooner than pure saving would allow. The goal is not to be debt-free as a matter of identity. The goal is to be free of debt that costs more than it produces, which is a meaningfully different standard. There is historical evidence for how persistently this dynamic plays out across economic conditions. During periods of low interest rates, sophisticated investors borrow heavily to acquire assets because the cost of that debt is low relative to the returns available in real estate, equities, and private businesses. During periods of high rates, they become more selective, but they do not stop using debt entirely. They simply raise the return threshold required to justify the borrowing. This is not market timing in the speculative sense. It is rate-sensitive capital allocation, and it is practiced consistently by anyone who manages money at a serious level. The 2010s were a particularly clear example of this behavior, as institutional investors, real estate funds, and individual operators with access to cheap financing accumulated enormous asset positions using leverage that, in retrospect, produced extraordinary returns relative to the cost of the capital deployed. The tax dimension of productive debt is another layer that rarely gets discussed in mainstream financial content, but matters enormously in practice. In many jurisdictions, the interest paid on debt used to acquire income-producing assets is tax-deductible, meaning the effective cost of that borrowing is lower than the stated interest rate after accounting for the tax benefit. A business owner paying 6% on a loan used to expand operations may effectively be paying 4% after the deduction, while the asset funded by that loan is generating 8 or 9% in returns. This further widens the productive spread and is one of the structural reasons why business ownership and real estate investment consistently produce better after-tax outcomes than wage income alone, regardless of the gross numbers involved. None of this means that debt is safe or that leverage cannot destroy wealth just as effectively as it can build it. The mechanism that amplifies gains also amplifies losses, and the history of financial crises is largely a history of debt deployed into assets whose valuations were inflated beyond what the underlying cash flows could support. The 2008 financial crisis was not caused by leverage itself. It was caused by leverage applied to assets whose real productive value had been systematically misrepresented. And when the gap between price and value collapsed, the debt remained while the asset value disappeared. Understanding productive debt means understanding that the asset on the other side of the equation must genuinely produce returns, not merely appear to be appreciating in a rising market. The practical implication of all of this for someone building wealth from an ordinary starting point is not that they should rush out and borrow as much as possible. It is that they should begin asking a more precise question every time debt enters the picture. Does this borrowed money go towards something that grows, produces income, or appreciates over time in a way that exceeds what it costs to borrow? If the answer is yes, and the numbers support it with reasonable assumptions, the debt may be a tool. If the answer is no, if the money is going toward consumption, toward convenience, toward experiences that leave no asset behind, then the debt is simply transferring future wealth to a lender in exchange for present comfort, and that trade is almost always worse than it feels in the moment. Wealth is not built by avoiding all debt. It is built by understanding which side of the productive divide every borrowed dollar sits on, and making that distinction with clarity and consistency over time. The wealthy do not have a different relationship with money in some mystical sense. They have a more precise one, and that precision, applied patiently across years and decades, is what separates those who accumulate assets from those who spend their working lives servicing the debt of others.